Ahead and get started. Well, first of all, thank you all so much for joining us for these amazing sessions that we're doing in partnership. My name is Roberto de la Peña Cervantes from Financial Beginnings, and I'm based out of California. And we're thrilled to have you all to dive into this month's topic, which is debt and credit management. And before we get started, I just want to take a moment to recognize the incredible partnership that makes this monthly webinar series possible. We are hosting this in close collaboration with Columbia Bank, and a special shout out to Linnell Bevels, who is the Vice President and Community Impact Lending Manager. For her leadership in bringing this series to life. So we're also proud partners with the Women's Council of ARPB, whose incredible team helps us share these financial empowerment resources widely across our communities. And most of our amazing presenters are joining us from the council. So thank you all so much. And yeah, just before we get started, for those of you that don't know Financial Beginnings, we are an organization that provides free, accessible financial education to help individuals take full control of their financial futures. And uh, today we have an incredible guest who's joining us to lead today's class. Her name is, and I'm deeply honored to introduce her. Her name is Petra Brady. She serves as the Director of Community Engagement and Membership for the Oakland African American Chamber of Commerce. She's an absolute expert at building community connections and helping local entrepreneurs and individuals find the high value resources they need to thrive. In addition to her leadership at the Chamber, as if that wasn't a lot already, Petra is a local entrepreneur herself. She's a Bay Area native and dedicated community advocate who spent nearly 2 decades volunteering with organizations like Kappa Alpha Sorority and the League of Women Voters. So we're incredibly lucky to have her sharing her expertise with us today. Petra, thank you so much for being here. Before we hand it over to you, Petra, I just want to give Linnell an opportunity to welcome y'all and to say anything that she'd like to add to this intro. Thank you.
Thanks, Roberto, and thank you, Financial Beginnings. It really is a wonderful partnership that Columbia Bank has had an opportunity to participate with for several years. For me, it's been a few years, but it's been a long-standing relationship. And when you look at platforms that have financial education, or at least in my experience, they've not been so robust. And I think that Financial Beginnings does a really, really good job of, cultivating, the latest and greatest, financial information that folks need to make informed decisions. But on behalf of Columbia Bank, as well as Women's Council of Associated Real Property Brokers, I welcome you. I hope that you all get really valuable information from today's session. Petra is going to give you all the information that you need around debt and credit management, and directly from the curriculum. So this is directly from the curriculum. So no pressure, Petra. So and I'll also add, Petra Brady, as the director of membership with the Oakland African American Chamber of Commerce, this is a whole like 360 collaboration because I'm actually on their board on the board with the Oakland African American Chamber. So I think that bringing these types of um, activations to the community, showing, a variety of community partners collaborating and working together, it's just a great demonstration of how, connecting and networking really can be a benefit for everyone. So enjoy your session and make sure that you keep up with the next session for next month and throughout the year because we have a session every month. Thank you.
Gosh, thank you, Linnell. Oh my gosh. Thank you, Linnell. Thank you, Roberto. Hi, everybody. I'm Petra. So there's no need to belabor it anymore. Just thank you for your patience. I'm very excited, a little bit nervous. And like Linnell said, these slides are prepped for me. So that helps a lot. We can just dive right on in. Roberto is going to assist me. Let's see.
Can
Thank
y'all
you.
see the PowerPoint okay?
Yes.
Yeah?
You can see it?
Okay.
Okay,
Wonderful.
cool.
Yes.
Okay, let's see, where are we? Sorry, I'm trying to manipulate a couple of things at one time here.
And while you're doing that, I forgot to shout out my third VP who was on the call, Miss Karen Allen. She's fantastic. She makes sure to take photos. And although, Karen, maybe we don't have to do that anymore because now we have the replay, and Miss Kathleen is going to help us navigate our
Right.
technical requirements.
No,
But
no more photos.
yes, thanks for being here.
Okay, let's see. So, as said before, I'm going to talk about credit and debt today. Um, I guess we don't need the presenter slide. We kind of already talked about that. Um, there are several different series within the SAFE program, and I've looked at them. I've looked at them. They're really great. But I'm going to talk about credit and debt. Go ahead, Roberto. Can you, Roberto? Okay, so that's me. Um, as Linnell said, I'm the director of the chamber, but what I do as my personal business is I educate people on their life and health insurance policies. So we can talk about that later. Today, we're going to talk about debt and credit. So the objectives today are to learn how to establish and maintain credit and how credit scores affect us when we're accessing different loans and opportunities. We're going to look at what the credit lenders do and how they identify their errors and fraud. And we're going to explore credit card loans and options. But the biggest thing that we're going to do today is we're going to understand how these things impact us when we're managing it. So if we start off with understanding credit, let's see. Okay, sorry about that. You're ahead of me, Roberto. Hold on a second. Hmm. So the different things about why credit is so important. It is what makes us do what we do. It's how we buy things. It's how we get things. And you tell me what you think about credit. What does good credit mean to you? Type it in the chat or just yell it out. We can all chat. We can all be friends here. Let me know what you're thinking.
Credit is freedom.
Yep. Thank you.
Credit is power.
Absolutely. Absolutely.
But it can be generational.
It can be. It can be generationally good and it can be generationally bad.
Exactly. Okay.
We learn those bad habits and it's hard to get out of them.
There's some folks in the comments that made some comments. Means you are responsible and accountable. That was from Lala Johnson.
Thank you, Lala. And that's also why it's so important because it's a reflection of us and it definitely affects parts of our lives when we're purchasing things. Roberto, I can't see the slides anymore.
I'm at the what is credit and why it's important.
Oh my
You
gosh.
can't see
Can
it?
anyone else see them?
Yes, I can see them.
I
I
can see
can
them.
see them as well.
Wow. Okay.
That's weird that you want to. That's weird. How come you can't see them?
I don't know.
Because
But
she
that's
might
okay.
have to be in presenter mode. She has to change her mode some way.
Or maybe you changed it by accident because
Um, I think Zoom has multiple windows. It's very annoying. Sorry about that, Petra. Yeah, it
There it
try
is.
yeah, just whenever
Okay,
that
cool.
happens, just click onto the other Zoom window because one of them is just a taskbar and the other one's the actual video.
Uh,
Okay, thank you. Okay, so Oh, I see what you're doing. Okay, now I see it. I'm sorry about that. Okay, so we're at the 5 C's of credit, and I can find my notes. That just threw me off a little bit. So the 5 C's of credit. First, let's talk about character. So your character refers to your reputation, as we were saying earlier, things that we come from our parents. And it refers to your reputation for paying your bills and your debt on time. And lenders look at this by looking at your credit history, of course. They also look at your previous loan payments, credit card payments, and any outstanding debt. Capacity looks at your ability to repay the loan based on your income and other money sources. So lenders want to make sure that borrowers have enough income to cover their existing bills on their new loan. Now, the next one, capital, to me, is really focused towards entrepreneurs because capital refers to the borrower's assets. And so lenders are trying to gauge how much money you, as the entrepreneur, how much skin you're putting in the game. They're looking at if you how much you've invested in that venture or purchase, as well as your overall stability. Collateral, something of value that you pledge to secure the loan, and you know what happens with a car, the repo man, if you can't pay that loan. And the last one is conditions. So conditions refers to the specific terms or conditions of the loan as well as other factors, interest loans, purpose, and the overall environment. So let's look at the credit scores. Ooh, that's a scary one. Credit scores, I credit scores have changed. Has anyone else noticed that? That number, it used to go up to, wasn't it 700? Now they've added another 100.
Uh,
Yeah,
really?
Yeah.
they've looked
Am I the only
different.
one that noticed that? Because I thought 700 used to be the top.
No. Well,
Oh, no, it's been eight for a while. It's been eight for a
Hasn't
while.
when I learned about FICO 1,000 years ago, literally, it was at, I want to say it was 840. It was never just stopped at 700. And this was like in the, when did FICO come out? Late 80s, early 90s.
Mm-hmm. Mm-hmm.
But the model, there has been some changes to the model, but it's not, because it was never 700 was never the cap. It was always above, and it may have actually been much higher than 800, but yeah.
Okay. Um, so as far as the credit score, you can look at several sources when you're searching for it. Of course, there's the big three agencies, Experian, Transparent, and Equifax, to get you your scores. And then there is the annual report, creditreport.com, which I am just learning this is the only authorized site by the federal government that provides free credit reports. And of course, there might be the opportunity to get your credit score from your bank. They offer a lot of services like that now, which I think is great. Fourth, we always have Credit Karma, and other different apps that can give you your scores. And finally, you can rely on people like Linnell or other credit advisors that can help you raise your score. For me, I think the thing to keep in mind when you're looking at the FICO versus the Vantage score, the Vantage score is used a lot for when you are renting. They look at that more when you're renting. And that one is comprised of the three scores together, the Experian and TransUnion. And
Mm, I don't know.
yeah, and then with the FICO score, FICO is really strong. Like Linnell said, it's been around much longer, and it's really used for 90% of the lending decisions.
Now, which one did you say that was free?
So the one that's free is the government one is the annual
Oh, okay. Yeah.
report.com.
Okay. Thank you.
So Yeah. Let's see. So next slide, if we look at the credit score itself and how it is made up. Let's see. So of course we have the payment history. We have the balance to limit ratio. We have the length of your credit history, which is about, that gives you about 15%. Your new credit is 10, and the credit mix is the last 10% of your credit score. So when you are looking at this circle, what's really good to understand is, as far as that mix of credit, you want to you do not want to have open credit accounts. If you have open credit accounts that you're not going to use, they are really down on that. And those unused accounts make up about a tenth of your overall credit score. So that's something to really look at because it can definitely um, cost you in the end. So of course we
Question.
know that.
I
Yes,
have a question.
I'm sorry.
So my understanding is if you have a credit, you shouldn't close it all the way. You shouldn't close it out all the way. So are you saying that even if it's still open, it still makes it look bad?
You're saying if you have an existing balance?
Not balanced. It's just closed. It's not, it's just open, but there's no balance.
No, that's a little bit different because what happens is people tend, once they get at that sweet spot of their credit, they start opening up a lot of accounts and then they don't use them. And that's what's not looked at properly. So if you're going to have it open, try to use it just a little bit. Um, just do a one purchase and then so that continuously makes your credit history or your repayment history look better. Don't just have it open and it's just sitting there kind of stalling. That's what's not considered a good look. Does that make sense? Did I answer your question?
Yes, you did. I'm sorry. I'm not working,
Okay.
so I'm trying not to have all that noise in the background.
No
So yes,
problem.
that makes sense. Thank
Okay,
you.
thank you.
Mm.
Okay, let's see. So if we look at the impact of these negative marks, it's I guess it's pretty standard. I think we all kind of know this already. Um, Max out your cars, you get 25 to 45. 30-day pays, 90. Foreclosures, bad, and bankruptcies are the worst. Um, Pretty self-explanatory. Let's see. So if we move on to how do we establish this credit? Sorry, I'm losing my place again. Um, so this part to me is, I think a lot of it is for students. But if you're just new starting your credit, it's still very good things to be aware of. If you're having if you need to establish your credit and you're a student, you can get a secured card. I don't know about you, but I know when I was a student at Cal, I went a little bit crazy with the cards, and they thankfully have gotten better not going after students the way they did, but it is a good way to establish credit. Also, if you're trying to establish credit, you can get a cosigner if necessary for certain items. Using someone else's credit can help you lift your visibility more, as well as you can use your either rent or utility payments just to show your good payment history. Okay.
Question before you go to the next one.
Yes.
And when you're renting, is the renters or the landlord supposed to automatically put you into that credit? It's called, I think it's Experian that uses that, or would you know
You're
that?
saying does the landlord put you into that, or does your
Yeah,
payment history automatically record it?
yeah, either or.
Let's see. I don't know the answer
See,
to that one.
I'll,
Lynette,
I
do
can
you
answer
know?
I'll,
that, Petra. No,
Okay.
no,
go
this
ahead,
is
Karen.
Karen. I can answer that. No, it does not. There's three different, uh, it's called rental.com there's several things that you have to go through to have it put on your credit, to show up on your credit bureaus. Some of them you have to go through the landlord, but there's some you don't even have to go through the landlord. But they're going to look at your bank account and see that you're paying your rent on time. So they're going to ask for bank statements. So no, it doesn't automatically do it. You have to do something as a renter to help it get there.
And can
Oh,
I
okay.
add to that,
Hmm.
Karen? Thank you. Some of the larger property management firms
Hmm.
automatically report to the credit bureau. So whether you're a renter or not, it's not even your choice. Some of the larger property management firms automatically, like Macy's and Nordstrom's and American Express, they just automatically have a relationship with the credit bureau. But more recently, um, the housing industry has been trying to get, small property owners, small landlords, single individual folks to actually start reporting their tenants' rents to the bureau to help that tenant build credit because there are plenty of folks who, if not for rent, they don't have any other debt, right? They don't have any other
Right,
credit. And
right,
so they are almost invisible, if you will, from a credit perspective because no one is reporting anything. But if the landlord would just start, and so that it's a whole thing. And I think that there are more smaller scale landlords who are attempting to report that information. So hopefully that answers your question.
what about utilities?
That is also something that is not automatically reported,
That is
but
reported.
it can be reported, but it's not, and it's not forever. It's like a transactional kind of a thing, right? If you're trying to buy a house or something else,
Okay,
typically a
okay.
house, you can, for a transaction, you can have that added to the credit bureau or for the purpose of the transaction. And after that, it doesn't, because PG&E does not report to the bureau. The only thing they report is a collection.
Oh, so I'm glad to know that because when I'm doing the credit and debit classes, that's one of the things they always ask me. Isn't this automatically that, my rent is supposed to be recorded and I'm supposed to get
Got it.
credit?
Yeah.
So yeah, that's good information to know.
Okay. Thank you. Thank you. Lynette, you sound like a
Yeah.
very good renter.
Your time,
Well, I'm
your
buying. I'm
I'm sorry. I'm
timekeeping.
buying.
kind of every time I hear about this stuff, I kind of think about the other side of that coin, but we won't go into that.
You're
And I'm
right.
also
Uh,
your timekeeper, Petra. So you've got just under 30 minutes.
okay. Oh, that's fine. Oh, wow. Okay, I need to talk faster. So of course, there's two different types of debt, um, loan and credit. Pretty self-explanatory. You borrow with a lump sum of money with the loan, and with a line of credit, you can have small installments over time. Okay, so categorizing debt. Sorry, lost my place again. So with the categorizing debt, you have the secured versus the installment plans, as I said before. The difference is with the secured, they're using your house or your car as your collateral, which is good for the lender. There's less chance of you defaulting on your loan if they're holding on to your car, getting the risk of getting it repossessed. With the unsecured loans, there's no collateral, but what they do is they go after your credit score, um, which is kind of like your lifeline. So if you don't pay back the loan on time or, in a timely manner, they're going to impact your credit score as well as a possibility of garnishing your wages to get that balance. So when you're choosing a credit card, there's a variety of options. Credit cards or loans, the same thing. There's always a variety for loan options. You want to look at the criteria that's listed, your interest rate, of course, what fees are involved. Um, Credit cards that offer rewards are always cool. And you want to think about your credit, your reputation, and how it's going to work with your other goals. So let's talk about these credit cards. Like I was saying, cashback rewards are great. Anybody that has a Southwest card, it helps a lot, even with all the luggage fees that they now charge. These are great ways to establish your credit and give you a little bit of bonus too when you're shopping and using the card for other items. So, let's see. Can you go to the next one, Roberto? There we go.
Okay.
Um, so when we're talking about leveraging the debt, let's see about what makes it good and what makes it bad. So of course, a mortgage is a very good debt because it helps you not only to purchase your home, and your home is an asset that appreciates over time. Also, your interest rates can be tax deductible. Student loans are also seen as good debt. We're investing in our futures with our students. That's always a positive thing. From the lender's point of view, we're not only investing in our future, we're investing in future debtors. So keep that in mind. It's a business for them. Um, Auto loans, I think with auto loans, it kind of varies. It really depends on how fast your car depreciates, and if the payments are a strain for you. Same is true for personal loans. It really depends. It depends on what you're using it for. It depends on how quickly you pay it back. Um, and you have to, I don't know, you're kind of put in a different light depending on what you are using it for with your lender. So, if you get out a loan and you say you're putting it towards, you're going to pay for your education, you're going to go back to school or something like that, that's great. But if you're taking out personal loans to go on vacation, not so great. Credit cards can be good. They're good when they're used responsibly, of course. And as I said before, you get those rewards for shopping and travel. But it can also be bad because credit cards have such high interest rates currently, and it makes it harder to pay off the debts. The last one, payday loans, they're pretty bad. They're pretty bad. They have the high interest rates, and it just doesn't look good when you are considering ways to um, get money. It just really doesn't look good. So the bottom line is think about how the debt is going to impact you, how it's going to look um, when you're going through the process of paying it back. I think that's really the main thing to think about. You also should think about the terms that's involved in the loan or the conditions. Um, but overall, it can be, these can be beneficial tools when you are using them correctly. Okay, next slide, please. So understanding debt. Okay. Um, that's okay. That's fine. Go ahead. Go ahead. Go ahead.
Sorry about that.
That's okay. So as we're understanding debt, we're going to be looking at the cost of the interest that you are paying when you are taking out this loan. So that can be looked at either simple interest or compound interest. There is the calculation there before you. Basically, a breakdown is with simple interest, you say you borrow $1,000, a simple interest of 5%, you'll owe 50% in a year, no matter how many years it goes. With compound interest, take that same sample. You're borrowing $1,000 for 5%, and the interest is added each year on that principal. In the second year, you're going to owe not just the interest, but also the principal. So that comes into play a lot with mortgage loans. um, I've learned about that. I'm a fairly new homeowner. I've only had my house about 2 years, and I'm definitely learning about that compound interest and paying off that principal when you're looking at a 30-year mortgage. You can go to the next slide, please.
Congratulations on being a homeowner, Petra.
It's more than a notion. Thank you. It's more than a notion. Um, so now we're going to talk about the annual percentage rate. So this is the annual percentage rate, which provides a way to measure the cost of borrowing money on credit cards. So they have fixed, or you can have the variable. So it's pretty self-explanatory. With a fixed rate, there's stability with you and the lender, because it is going to stay consistent. That interest rate doesn't change. Pretty much just like planning for your budget, just like a regular monthly bill. With the variable rate, it's going to float a little bit. It might fluctuate just slightly from time to time, especially you are looking at a prime rate that is given by the bank, and that's going to be lower sometimes, it's going to be higher sometimes, and there is the potential for savings with that one, but there's also a risk over time. So let's see. Can you go to the next slide, please? Okay. So this gives you a really good example of short-term versus long-term borrowing. Um, Again, it's self-explanatory. You have longer payments, but you're going to be paying more interest over time. So you kind of have to balance what works best for you. The shorter payments with a larger amount and less interest, or the reverse. That's pretty much it. Um, so this slide was really interesting. I said, if you look at the did you know part, oh, I just talked about that. So you're talking about you're paying off that principal, which is really, really the key, instead of the initial amount that was borrowed. If you look at the chart, it's pretty interesting. I thought that was a pretty interesting slide. Um, and again, this is how you get into that trap where you're either pay more now or you pay more later. You either increase your monthly payments, pay it off quicker and pay off less interest, or you stretch it out some more and you pay more over time.
Can I just add something here?
Sure.
A mortgage consultant of 33 years, so I have something to say about credit.
Okay, go ahead.
Um, you know, obviously some of this stuff, you know, having, accounts that run longer than others, you're paying more in interest. Ideally you would not want to do that. However, some people that's their strategy for any number of reasons. And so, when you think about, credit and the types of debt you decide to employ, you want to make sure that you have a strategy, and everybody's strategy is going to be different. Some people are going to need shorter term. Some folks are going to need longer term because it's part of their strategy. There is no one fit solution for anyone. We all have very different sets of circumstances. Some people own, so they get the benefit of a tax deduction, while other people might not, and they have other um investments that allow them to get, kind of those write-offs. But the point is with the credit component, just know that, you know, even the good and the bad, sometimes it serves a purpose, and everyone has their own reason why they set up things the way that they do. And the last thing I will say is I dropped in the chat the conversation we were having earlier about FICO.
Mhm.
The model started in 1989, and the range is 300 to 850, and it's been that way. And then you've got like this range, and it's in the chat that shows you what the industry believes to be poor, fair, good, very good, and exceptional. But the average person is actually at that fair to good, the average person. So there you go.
Thank you.
Okay.
I love the support. So let's talk about repayment strategies when we're dealing with our credit card bills and such. Um, as you can see, there's three here: snowball, avalanche, and full consolidation. So um, the snowball method, that's the one I use. Start off small. So what you do is you write down all of your balances and you basically start paying off the smallest ones first. And it really does lead to a quick momentum. It kind of makes you feel good as you just kind of ping them off, just kind of knock them down, knock them down, knock them down. Um, with the avalanche method, you are paying off the ones, your debts that have the highest interest first, which, as we were talking about before, that helps you save money in the long run. So it's really a matter of, as Linnell was saying, what works best for you. Um, if anyone, and of course, debt consolidation is you combine everything together and just have one big monthly bill. Um, so the thing about the debt consolidation, I would say, if it works for you, it's great. I think it's great if it works for you. You might find it easier to help you budget and stay on track because you've just got that one big bill that incorporates everything. The thing to think about is there it could make your overall um, debt longer because now you've got everything lumped into this big thing, and there may also be some fees involved to put all of your debt together. Okay, what if I can't pay? Well, as you can see, um, you definitely want to talk to your creditor or your lender. Usually, they're very understanding. They want to. They really don't want to lose you as a customer. If they can work with you, they will. Um, it's better for them to keep you paying than to going through all the things necessary to completely remove you or to go through bankruptcy and that type of thing. It's a lot easier to just keep you as a customer. So I would definitely recommend that. Usually they want to work with you. They really, really do. Um, Seeking credit counseling, I can't speak on that. I haven't done that personally, but I know it's an option. That would go back to you consolidating your debt. And then, of course, there is bankruptcy if you don't find any other option. Um, if that would be your last resort, try to avoid that if you can, because it's going to stay on your credit history for 7 years, which is even, as you're trying to rebuild, it really does take a while to reestablish yourself if you have that bankruptcy on your credit report.
And I'd like to add
Hmm.
that, one of the things about Financial Beginnings is that they have a lot of resources on their website to help you in this regard. And there's a myriad of resources online besides Financial Beginnings that can help you, kind of navigate credit concerns. You have the Consumer Financial Protection CFP Bureau, Consumer Financial Protection Bureau, that has, a wealth of information about um, credit and, what things that can and cannot help you. So I would say that ignoring what is upon you is probably the worst case scenario. However, having been a mortgage consultant for a long, 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 long time, I know that sometimes that is human nature where people decide to ignore their mail, ignore the calls, ignore the emails, and then all of a sudden they've got an avalanche of collections and all those things. But, as they say, how do you eat an elephant? One bite at a time. So as it relates to clearing up credit concerns, you just take it one step at a time. There's no judgment. There's so many resources out there to support people, so you don't have to feel like you're, going it alone, but definitely visit the Financial Beginnings website for the resources that they have to help you in that regard.
Thank you, Linnell. I would like to definitely echo that. Um, just, don't feel bad about being human. I think it happens to all of us from time to time because, life changes, and sometimes you can't pay your bill as quickly as you'd like to, and maybe sometimes you can't pay it at all, but don't feel guilty. Don't absorb all the guilt. Um, it's okay. It's really okay, and you can survive it. I know that I know if you even if you do have to end up filing a bankruptcy, you can get over it. You can resolve it. It just takes time. So seek the help that you need, and don't even feel guilty about it. It's part of life. So next steps, take action, keep learning, analyze. I think analyzation is one of the biggest components because another thing that happens with us humans, I'll speak for myself, is you're doing so much until you don't realize that your debt has piled up to the extent that it has. You might be late a month or two, and you think it's only a month or two, or let's see what's happened to me in the past. You think your automatic debit is coming out of your account, and then suddenly something happens, and you're so busy you don't even realize it, and then you're getting called by creditors like, we haven't received the payment in 2 months, and it's like, oh. So again, try to be aware and just check in. With online banking, it's so easy to just put things on automatic and let it go, but do analyze your credit report, your online banking, make sure those automatic debits are being charged when they're supposed to be, and get help and continue to learn and talk to your friends. Again, going back to being human, I think everyone goes through these things from time to time. So there really is no guilt. And um, it's been so imperative for me, especially when buying this house, to get that experience and wisdom from people that have gone through similar things. And that certainly applies to um, paying off credit card bills. Absolutely. So, this is the survey. Please feel free to scan it and give your feedback. Is that the last slide?
Yeah, that's the last slide. If anyone, we can open it up for questions right now. If anyone has any, if anyone has any questions, feel free to either just say them out loud or put them in the chat, and then we if we have the answer, we'll give it to you now. We have lots
My
of professional.
question is for Linnell.
Okay.
I always get this question when I teach this class. When you turn, after you graduate from high school, what is your credit score? If you never use any credit, what is your credit score? Is it 300? Or, I mean,
It would probably be nothing because the credit score is it only has it gets activated by you getting credit. So if you don't have
oh,
the
okay.
credit, when you run the credit, it's going to be nothing.
Okay.
Yeah.
All right. Good answer. Thank you.
Mhm.
So this is Karen. Can I jump in and piggyback on that? So you're absolutely right. I'm dealing with a client right now that has no credit score. Now, this is a grown man. He has no credit score. He has no credit. He and his wife had everything in her app name, had all the bills taken care of. He have absolutely no credit. So we're having to establish credit for him right now.
Non-traditional credit, Karen. So someone asked a question earlier about utility bills,
He
right?
has non yes, he can get non-traditional. He doesn't have the traditional credit card like or other loan type credit.
Right. Yeah. And I'm just now piggybacking on what you're saying, just to close the loop on that, is that, yeah, you do have people who are, off the grid, invisible from a credit perspective. And there's lots of people who have motivation for that. Not saying that to say it makes it very difficult, but you can build a credit file. It'll be a thin file. And as I said earlier, it's just for the transaction. So this particular individual would have to provide 12 months of proof of payment for utilities, right? Would have to provide proof of payment for rent, whether it be the landlord responding or this individual providing canceled checks or proof of payment in his account. And then what happens is that information gets submitted to not the bureau necessarily, but the agencies that kind of work with the banks and lending institutions, right? We don't work with the bureaus per se. We work with, service providers, if you will, who go in and grab that data. So for our purposes, from a lending perspective, we can ask them, can you manipulate this particular credit report and add this information? It's not going to be a permanent fix, but it's an avenue for a lot of folks to be able to buy houses, more buy houses than anything else. Because buying houses, it seems like their credit is more flexible than it would be if you try to get a credit card. So uh, hopefully that helps. Now I added to the chat again some information. I mentioned Financial Beginnings online learning portal. I put the website there, and I also talked about the Consumer Financial Protection Bureau. They've got a wealth of resources. I put that link in the chat as well.
I have another question. Oh shoot, I forgot what it was. Um, okay, never mind. I forgot. I forgot that quick.
I just wanted to say thank you again to everyone for coming today. Thank you, Linnell and Karen, for your support. Appreciate y'all. If anyone has any questions about the Oakland African American Chamber of Commerce, I put it in the chat, as well as if you have any questions about building wealth with your life insurance, feel free to call me. I also put my number in the chat. It's been a great experience. Thank you. Thank you,
Thank,
Roberto.
Thank you,
thank you,
Petra. Thank
Petra.
you, everyone.
Awesome sauce. Thank you,
Yeah,
Petra, for
thank you,
agreeing to be
Petra.
our facilitator for
Thank
today.
you. You're
Appreciate
right.
you. And thank you, Roberto.
Thank
And
you.
congratulations, Petra, on your first house. That's
Yeah, that's amazing.
wonderful.
Yeah.
Thank you.